Well, hello, everyone, and thanks for joining today. My name is Grayson Geiler with SES Services. What I'd like to do is pick a topic from the financial media and weekly go through a little bit of an analysis with that topic. And today, what I'd like to talk about is the energy crisis that we're looking at in Europe. So a big part of the headlines out there, the European debt crisis we talked about a couple of weeks ago, but now with the energy crisis and of course the Ukraine and Russia challenge going on, Vladimir has pretty much cut the Europeans off of the natural gas pipeline. So of course, that's a serious concern. We're headed into winter, and just in broad and general terms, Europe is depending on Russia for about 40% of its energy. That's broad and general, and exactly how this rolls out with Vladimir cutting the Europeans off remains to be seen. But of course, it's a big topic in the financial media and in the press. Now, one thing to understand is it's not just, hey, we're going to have a tough time heating our homes in the industrial countries like Germany. But as you've experienced with higher energy prices here, that's the bedrock of the economy. The energy, cheap energy is very important to have the economy running on all cylinders. And so there's going to be some follow through to some degree that we haven't even really thought of yet with the European economy, with energy getting shut off. I mean, this is probably have some rolling blackouts, maybe onto some really serious issues with people freezing. Food production is way down. Europe also, just to add fuel to the fire, Europe also had one of its worst droughts in all of history. So some things look pretty serious over there right now. And of course, the question comes out, well, how does that roll over to America? Does this filter down to us with our investing, with our economy? What do we need to be on the lookout for here? One of the things, and we've talked about quite frequently in our weekly updates, searching the financial media, searching the financial markets for some clues about what might be going on. Of course, we've mentioned historically, we are really worried about the Japanese economy, the Japanese monetary system, because of the drastic weakness recently in the Japanese yen. So one of the things that we're trying to keep our eyes on within the financial media is the euro. Now, you may have heard just in the last couple of weeks, the euro, which was typically, a significant premium for the U.S. over the U.S. dollar, meaning to buy €1, it cost you about $1.20, $1.30, even over $1.50, some 15 years ago. Well, the euro got priced less than $1 in the last couple of weeks, went discount to the dollar. So taking a look at the chart here, you can see over the last few months, spring into summer, there's been some pretty significant weakness in the euro. Is that an indicator of economic problems that they may have coming in to the winter with their energy problems? Well, it certainly is. Now, again, referencing the Japanese yen that we've called the canary in the coal mine of the world's monetary system for more than a decade now, the chart looks a whole lot worse than this. Clearly you could ski this chart, but the Japanese yen chart looks much worse. The euro hasn't been priced less than $1 for more than a decade. It got there in the last week. So there's a lot of negativity already priced into the situation going on in Europe. Right now, some of the dollar strength versus the euro has to do with assets coming to America, buying into the US dollar, buying into our financial markets from around the globe as a safe haven, as part of what's going on. And this is a tough chart to say it's actually a good thing, but in a way, we believe it kind of is. The European situation could be a lot worse than it appears to be right now. So of course that can change quickly if you have a situation where an early Arctic air blast comes down from the north and the Europeans are in dire straits with less energy. But we'll see how that rolls out. One of the concerns we also have is there are a lot of European leaders that don't seem too concerned about what's going on with the energy situation, or at least some of them seem to be actually applauding lower usage of the energies coming out of Russia. Well, you know, if we could wave a magic wand and fast forward 50 years, of course, I think every reasonable person would like to see renewable fuels comprising a much higher percentage of our energy usage than they do. The reality, the economic reality in the near term is we have to have natural gas. We have to use coal. We have to use crude oil. Right now, we're hearing stories of Germans out in the woods cutting wood down and stacking it up, preparing for the winter. So I guess at least somebody's doing something. How far does this roll over into all their financial markets? Again, we see a lot of negativity already priced in Europe, and things aren't coming apart. So some pressure may come off the European markets, as they have here in the last couple of months. So, you know, when we see a situation, the conditions of the markets over in Europe still potentially could get pretty nasty, could have some serious economic slowdowns, shutdowns because of what's going on. But the way the financial markets, both in Europe and in America, are behaving right now, it appears that some of that negativity has been overblown and some pressures coming off the market. So that's a good thing. So if you've had a tough time sleeping over the last few months because you feel like you have too much risk in your portfolio, the market is definitely taking its foot off your throat. So it's a good time to readjust if you feel like you have too much risk on. Now, of course, coming up this week, we've got our consumer price index CPI numbers coming out this week in America. I think the average trade guess is right around 8%. So inflation is coming in. Now, we've had a pleasant surprise, I guess you could call it, with crude oil. The price of crude oil backing off well into the $80s per barrel. From well over $100 a barrel a couple of months ago with the Ukraine-Russia conflict. So that's surprising. Of course, that takes a little pressure off of inflation when the crude oil prices come in. We'll see how that ends up rolling out later in the week. So, of course, the Federal Reserve, they're talking very hawkish, which means they're tightening the credit system because they want to fight inflation. Well, they're probably going to raise the short-term interest rates again next week, but it is encouraging when we see some of the prices already coming in. Now, we're a little bit concerned that some of the prices we see coming in, whether it's in crude oil or also in the employment marketplace, some wages coming in, more unemployment, not such a tight labor market is a very important indicator for the Federal Reserve when they're talking about raising interest rates. So the economy is loosening up, lightening up. Things are slowing down. When you look at some of the asset markets, especially real estate, things have drastically slowed down. So inflation is backing off. Therefore, again, some of the financial markets the pressure has come off financial markets, but we're a little bit reluctant to get too excited about using bad news as good news, that we think asset prices are going to go a lot higher because the economy is weak and the Federal Reserve therefore won't have to raise rates as fast. We're a little bit reluctant to get excited about adding risk in the bad news is good news sort of pricing of assets. A lot of the backing off of inflation is reduced demand rather than supply chains correcting and an increase in supply. So there's still some storm clouds on the horizon, and we need to be cautious. Obviously, Europe, the energy situation in Europe could spill over into our financial markets, so we need to be aware. But again, appearing a little bit like, well, not a little bit, quite a bit like the downside got overemphasized. So some pressures coming off financial markets. If you've got a use for some of your funds in the near to medium term, they've been locked up in assets that have been selling off and have now bounced, it's a good time to readjust your portfolio. We'll see how markets react going forward over the next couple of weeks, where we see domestically here consumer price inflation numbers, and then of course the Federal Reserve raising interest rates next week. So that's what we wanted to talk about this week. If there's anything we can do to help you, we're more than happy to sit down with you for a cost-free, obligation-free consultation. Just give us a call. Hope all is well. Thanks for sitting through our presentation today. Hope you enjoyed it. Hope to see you back soon. Thank you.